Let's get one thing straight. This whole GameStop saga isn't about a bunch of kids on the internet getting lucky. It's not some flash-in-the-pan meme stock craze that came and went. This is a story about a deep systemic fight that has been brewing for years, a battle between the so-called dumb money and the giants of Wall Street who thought they were invincible. And at the center of it all, you have these almost mythical figures. You've got Keith Gill, also known as Roaring Kitty, the guy in a red bandana who saw something nobody else did. He laid out his thesis with mountains of research, showing everyone the cards the big guys were holding. He wasn't gambling. He was making a calculated, informed bet against institutional arrogance. Then you have Ryan Cohen, the activist investor turned CEO, who strolls into this beleaguered company with a vision and a smirk. He's the guy who looks at the hedge funds shorting his company into oblivion and basically says, "Go ahead, make my day." His famous quote, "They can short the stock," wasn't a sign of weakness, it was a taunt. It was a challenge to the very people who believed they controlled the market. This isn't just business, it's personal. It's a drama playing out in real time, with billions, if not trillions, of dollars on the line. It's a story of David versus a Goliath who, it turns out, might be standing on a foundation of pure sand. The narrative that the mainstream financial media tried to sell us was simple. Retail investors are reckless, they're emotional, and they're going to get burned. They painted a picture of chaos, a nonsensical blip in an otherwise orderly system. But what if the chaos wasn't coming from the retail investors? What if the chaos was always there, hidden just beneath the surface? What if the orderly system was just an illusion, propped up by financial tricks and backroom deals? This story isn't about a meme. It's about the moment the curtain was pulled back, revealing the wizards of Wall Street were just men playing a very dangerous, very rigged game. And here we are, today, on October 10th, 2025, and the story is far from over. In fact, it's only getting more intense. The battle lines have been redrawn, the stakes are higher than ever, and new evidence keeps piling up that suggests the initial squeeze in 2021 was just the opening act. The real fight, the one that could fundamentally reshape our financial landscape, is happening right now. It's a complex, thrilling, and frankly, terrifying spectacle. So grab your popcorn, because the main event is just getting started, and it's about a lot more than just a video game retailer. It's about who really holds the power. Remember January 2021? The world watched, completely stunned, as GameStop's stock price went vertical. The official story was that a Reddit group, Wall Street Bets, coordinated a massive buying frenzy that caught a few hedge funds off guard. It was a classic short squeeze, we were told. But that wasn't the whole story, not even close. What we've learned since then is that the situation was far more dire and far more corrupt than anyone imagined. The reported short interest, the number of shares borrowed and sold short, was an astronomical 140%. But even that number was a lie. The real short interest, buried in complex derivatives, was later discovered to be over 226% of the company's entire public float. Think about that for a second. For every one share of GameStop that actually existed, more than 2 had been sold short by institutions. How is that even possible? The answer is a dirty little secret called naked shorting. This is when a hedge fund or bank sells a share they haven't borrowed or even located. They're literally selling a phantom share, an IOU, with the promise to buy it back later. They were so sure GameStop was going bankrupt that they didn't even bother to find real shares to short. They were betting on the company's death, and they were willing to create counterfeit shares out of thin air to make it happen. This wasn't just a bad bet. It was a flagrant manipulation of the market. This uncollateralized phantom share creation is what turned a regular short squeeze into a potential powder keg for the entire financial system. When retail investors started buying and holding, they weren't just squeezing the reported short positions, they were calling the bluff on all the phantom shares that institutions had created. Suddenly, those hedge funds needed to buy back not just the shares they had borrowed, but also the ones they had fabricated. The demand was infinite, but the supply of real shares was finite. This created a panic, a frantic scramble to cover positions that mathematically could never be covered. It was a perfect financial storm, and it exposed a level of rot at the core of the market. The institutions weren't just caught in a bad trade, they were caught red-handed. They had leveraged themselves to the moon on a bet that was predicated on their ability to control a stock's destiny, to drive it into the ground with impunity. The 2021 squeeze was the moment the dumb money realized the emperor had no clothes. They stumbled upon a vulnerability in the system so profound that it threatened to bring the whole house of cards down. The institution's only escape was to hit the emergency brake, to change the rules of the game mid-play, which is exactly what they did. But they didn't fix the problem. They just kicked the can down the road. So what do you do when you're a multi-trillion-dollar financial institution and you've been caught with your pants down, holding a bag of toxic, uncollateralized short positions? You don't admit defeat. You don't take the loss. No, you find a way to hide it. You bury the evidence. This is where the story gets even murkier, moving from simple arrogance to outright obfuscation. The banks and hedge funds that were trapped in the GameStop squeeze began using complex financial instruments, like total return swaps, to conceal their massive, unwanted short positions. It's a sophisticated shell game designed to keep their losses off the books and hidden from public view. Here's how it works. A bank with a giant short position on GameStop can enter into a swap agreement with another party, maybe another bank or a fund in a different jurisdiction. In this deal, they essentially trade the returns of their position. The bank pays a fee, and in exchange, the other party agrees to take on the risk and the reporting requirements of the short. The original bank no longer has to report the short position on its own books, making it look like the problem has vanished. But it hasn't. The toxic bet is still out there, festering in the dark, passed around like a hot potato until the music stops. This isn't a new trick. We're seeing the exact same pattern play out in the silver market, which is like the GameStop situation on steroids. For years, a handful of major banks have held colossal short positions on silver. We're talking notional values that are rumored to be in the trillions of dollars for each institution. They do this to suppress the price of physical silver, which is a key component in the fractional reserve banking system. By keeping the price of precious metals artificially low, they maintain confidence in fiat currencies like the dollar. It's a massive coordinated effort to manipulate a global commodity market. Just like with GameStop, these banks are shorting an asset whose real-world demand is exploding. Silver is essential for solar panels, electric vehicles, and countless electronics. We are running a massive annual supply deficit, meaning we use way more silver than we mine each year, yet the price remains stubbornly low. Why? Because the amount of paper silver, the futures contracts and derivatives, dwarfs the amount of actual physical silver in existence. It's the same playbook: create a mountain of IOUs to control the price, and when the bet goes wrong, use swaps and other tricks to hide the losses. It's a system of lies built on top of other lies. While the big banks were busy playing their shell games, something remarkable was happening over at GameStop headquarters. Under Ryan Cohen's leadership, the company wasn't just surviving, it was transforming into a financial juggernaut. They launched what became known internally as Project Rocket. The mission was simple: build a fortress of cash so impenetrable that the company could not be bankrupted, no matter what Wall Street threw at it. They used the elevated stock price from the squeeze to raise capital, issuing new shares and building a war chest that would make most Fortune 500 companies blush. It was a brilliant strategic move, turning the hedge fund's own attack against them. As of early 2025, GameStop is sitting on a mountain of cash, estimated to be somewhere between $4.8 billion and a staggering $10 billion. And here's the kicker: it has zero interest-bearing debt. Let me repeat that: zero debt. In a world where corporations are leveraged to the hilt, GameStop is an anomaly. Its cash-to-assets ratio is a stunning 74%, compared to the S&P 500 average of just under 15%. This isn't just a healthy balance sheet, it's a weapon. It makes the original short thesis that the company was headed for bankruptcy not just wrong, but laughably absurd. The very foundation of the short seller's bet has been obliterated. This financial strength gives GameStop infinite runway. They can weather any economic storm, invest in new growth areas, and continue their pivot away from traditional brick-and-mortar retail without the pressure of creditors breathing down their necks. In fact, they recently closed over 400 stores in a single month, a strategic downsizing that, for any other company, would signal distress. For GameStop, it's a sign of discipline, a move to cut costs and focus on profitability, which they achieved in late 2024. They are now a lean, profitable, cash-rich company with a cult-like following of loyal investors who refuse to sell their shares. This creates an impossible situation for the short sellers. Their original thesis is dead. The company they bet against is now one of the most financially secure companies on the market, yet the stock price remains suppressed, hovering at levels that don't even reflect the cash per share the company holds. This isn't a normal market dynamic, it's a sign of extreme ongoing manipulation. They are trapped. They can't let the price run because that would bankrupt them. But they can't drive the company to zero because it's sitting on a mountain of cash. They are stuck, holding on to their toxic short positions, praying for a miracle that will never come. If you think the GameStop situation is insane, let me introduce you to its big brother, the silver market. The parallels are chilling, and they reveal that this isn't just about one or two rogue hedge funds, it's a systemic issue. Just as institutions built up an impossible short position in GameStop, a cartel of major banks, names you know like JP Morgan and Bank of America, have allegedly built up massive short positions in silver. The notional exposure is rumored to be in the tens or even hundreds of trillions of dollars. It's a bet so large it's almost incomprehensible, and it's all aimed at artificially suppressing the price of physical silver. Why would they do this? Well, it goes back to the very foundation of our financial system. The price of precious metals like gold and silver acts as a barometer for the health of fiat currencies. If silver's price were allowed to rise to its true market value, it would signal a loss of faith in paper money, like the US dollar. It would expose the inflation and debt that the system is built on. So for decades, these banks have allegedly used the paper derivatives market, futures and options, to keep a lid on the price. They've created a supply of paper silver that is orders of magnitude larger than the physical silver that actually gets mined from the ground. The problem is, reality is starting to catch up with them. The demand for physical silver is exploding. It's a critical component in the green energy transition. You need it for solar panels and electric vehicle batteries. It's essential for modern electronics, from your phone to your laptop. The world is demanding more and more physical silver, but thanks to years of price suppression, mining companies have had little incentive to invest in new exploration. The result? We now have an annual supply deficit of over 100 million ounces. We are consuming silver faster than we can pull it out of the earth, and the gap is widening every year. This creates the exact same pressure cooker scenario as GameStop. You have a finite and now shrinking supply of the physical asset, but you also have a ridiculously oversized paper market of short positions betting on its price to stay low or go down. Every ounce of physical silver that is taken off the market and put into a solar panel or an EV is one less ounce available to cover those paper shorts. The banks are shorting an asset whose fundamental supply and demand dynamics are screaming for a higher price. It's an unsustainable position, and just like with GME, the moment of reckoning is getting closer every day. At the heart of both the GameStop and silver manipulations is a concept that underpins our entire modern financial system: fractional reserve banking. Now, it sounds complicated, but the idea is pretty simple. A bank doesn't have to hold all of its depositors' money in a vault. It only needs to keep a small fraction on hand and can lend out the rest. This is how money is created in our economy. The same principle has been applied to assets. You have fractional reserve stock settlement and fractional reserve commodities. The system is built on the assumption that not everyone will ask for their money, or their stock, or their silver at the same time. This system works fine, as long as confidence remains high and no one looks too closely at the books. But, well, it's also a system that is ripe for abuse. Naked shorting is, in essence, the ultimate expression of this fractional reserve mindset. It's the creation of a share out of thin air with no underlying asset to back it up. It's an IOU, a promise. The banks and hedge funds shorting GameStop and silver have been operating on the assumption that they can create an infinite number of these IOUs because they believe they will never be called upon to actually deliver the real thing. They believe they can always find a share or an ounce of silver later. The problem is, the retail investors in GameStop and the industrial users of silver are breaking the model. They are not just trading IOUs back and forth, they are demanding delivery of the actual physical asset. GameStop investors, through the direct registration system, are pulling their shares out of the brokers' hands and putting them in their own names, removing them from the pool of shares available to be lent out for shorting. Similarly, manufacturers are buying up physical silver and locking it away in products. They are calling the bluff. They are asking for the real thing, and the system is starting to realize it doesn't have enough to go around. This is the fundamental crisis. The fractional reserve system can't hide the real risks anymore. The discrepancy between the number of paper claims, the shorts and IOUs, and the amount of the real asset, the shares and the silver bars, has grown too large. It's like a coat check that has given out 1,000 tickets but only has 100 coats in the back. As long as only a few people come back at a time, the scam can continue. But the moment a crowd shows up demanding their coats, the entire operation collapses. That crowd is now forming for both GameStop and silver, and the people running the coat check are starting to sweat. For years, whenever the financial system got a little too wobbly, the Federal Reserve had a magic button it could press. It was called the Reverse Repo Facility, or RRP. In simple terms, this was a place where banks and money market funds could park their excess cash overnight with the Fed and earn a little bit of interest. It acted as a giant sponge, soaking up excess liquidity from the system and preventing things from getting out of control. It was the financial system's pressure release valve, its ultimate backstop. A few years ago, it held over $2.5 trillion. Today, as of early 2025, that facility is effectively empty. It has been drained to zero. The big stop button is gone, the sponge is dry, and this is a monumental development that has gone largely unnoticed by the public. It means the Fed has lost its primary tool for managing short-term market stability. With the RRP at zero, the financial plumbing is now under extreme pressure. There is no longer a safe place to absorb the shocks. This leaves the Fed with very few options to counter the next wave of systemic stress. And that stress is building, especially for those holding risky short positions. The unwinding of these positions is now not a matter of if, but when. With the reverse repo facility out of commission, the Fed is being backed into a corner. Its only remaining powerful tool is to cut interest rates. They have to. As systemic stress continues to grow, and with no other way to inject liquidity and calm markets, rate cuts become inevitable. But here's the irony. Cutting interest rates is like pouring gasoline on the fire of the GameStop and silver short positions. Lower rates make it more expensive and mathematically unprofitable to hold short positions, especially those funded by things like the Japanese yen carry trade, which relies on interest rate differentials. When the Fed starts cutting rates, it will trigger a cascade of unwinds. The math that made these massive short trades viable will simply fall apart. It will force the closure of the swaps that were used to hide the original GME shorts. It will force an unwind of the yen carry trade, which will in turn force the closure of even more hidden short positions across the market. The very act the Fed must take to save the system will be the act that exposes the rot within it. They are trapped in a feedback loop of their own making, and every potential solution only makes the underlying problem worse. As the pressure mounts, the institutions are getting more and more desperate, and nothing shows their desperation more clearly than the recent fiasco with GameStop and BBBY warrants. Warrants are financial instruments that give the holder the right to buy a company's stock at a specific price. Recently, new warrants for these companies have appeared, but there's a huge problem. Many are believed to be naked. They are being created and sold without any underlying shares to back them up. It's the same naked shorting playbook, just repackaged in a different wrapper, essentially resetting the clock on the squeeze. The manipulation has become blatant. Brokers like JP Chase have been caught force liquidating these warrants from customer accounts. On many exchanges, investors are finding that they can only sell their warrants. The buy button has been disabled. This is not normal market behavior. It's a clear sign of a delivery crisis. The sellers of these naked warrants cannot find the underlying shares to deliver, so they are trying to force everyone to sell them back. They are trying to extinguish the fire by taking away the fuel, but all they are doing is showing everyone where the fire is. The scheme gets even more diabolical. We are now seeing evidence that institutions are taking these newly created warrant shares, which have a 15-month expiry, and placing them into total return swaps. Why? To kick the can down the road one more time. By putting them in a swap, they can push their obligation to deliver the shares past the warrant's expiry date. It's a desperate last-ditch effort to hide their failures to deliver. They are literally trying to run out the clock on their own fraudulent instruments, hoping the problem will just disappear when the warrants expire. It's financial alchemy. and it's a sign that they are completely out of legitimate options. This is the endgame. We are seeing a mountain of fails to deliver, which are settled on a T+35 cycle. This growing pile of FTDs is the paper trail that will ultimately expose the true scale of the naked shorting. The warrant manipulation, the disabled buy buttons, the swaps with 15-month expiries, these aren't signs of a healthy, functioning market. These are the frantic, panicked actions of institutions that have been caught in a trap of their own making. They are trying to patch a dozen holes at once, but the water is coming in too fast. They told us the system was unsinkable. They built a financial Titanic, a marvel of modern engineering, complete with complex derivatives, high-frequency trading, and a fractional reserve engine that could create wealth out of thin air. They told us it was too big, too sophisticated to fail, but they built it with a fatal flaw: greed. They steered it recklessly into iceberg-infested waters, convinced they were masters of the universe. The iceberg was GameStop. It was a small, seemingly insignificant object on the horizon, but it struck the hull in just the right place, exposing a fatal weakness, and now the unsinkable ship is taking on water. For years, they've been trying to patch the holes. The total return swaps were a patch. The manipulation of the silver market was a patch. Disabling buy buttons was a patch. The naked warrants were a patch. But the ship is listing. The watertight compartments designed to contain the damage have all been breached. The corruption has spread from one area of the market to another, and now the entire structure is compromised. They can't patch it anymore. The leaks are too numerous, the damage too severe. The ship, weighed down by decades of uncollateralized bets and systemic fraud, must eventually sink. What comes next will be wild, thrilling, and deeply unsettling for anyone who has put their faith in this system. The exposure of these hidden short positions in GameStop, in silver, and who knows where else, will not be a minor correction. It will trigger a massive generational transfer of wealth. We are talking about the potential unwinding of tens or even hundreds of trillions of dollars in fraudulent positions. The wealth that was siphoned out of the real economy through market manipulation will be forced back. It's a reckoning that is long overdue. This was never just about one stock. It was never about dumb money getting lucky. It was about a group of ordinary people who pulled on a loose thread and unraveled a tapestry of corruption. They exposed a system that was rigged from the start, a casino where the house always wins because it prints its own chips. The coming storm is not something to be feared by those on the right side of the trade. It is something to be welcomed. It is the necessary, painful, and ultimately cleansing process of tearing down a broken and unfair system. The players have been played for too long. It's time for a new game. Power to the players.